my freaking lips. Nothing has changed.
Palantir is an enrichment scheme in order to enrich insiders at the expense of investors. It's created a mass movement of investors piling into a momentum-driven stock, while the insiders sell and enrich themselves and collect billions of dollars. As part of this, we see YouTubers promoting the stock and selling their own courses. They benefit from it while the retail investors get destroyed. To put the numbers into specifics, we have Palantir has issued $692 million in stock-based compensation in the past 12 months, which is actually more than they made in EBITDA. EBITDA is excluding the interest they make from the cash. That's how they make 40% of their money. We've seen Alex Karp cash out $1.2 billion in insider selling. It's just an enrichment scheme to enrich himself and the employees at Palantir at the expense of investors.
It's not a fluke. A company doesn't go up in 5 years by 1,000% because of a meme. There is no meme that lasts for 5 years.
It's important to point out that these investors in Palantir, like Tom Nash, are stock price bros. A stock price bro is somebody who only uses the stock price to justify any type of reasoning on the company. Oh, the stock price is up a lot, so therefore it's a good company. Even if it's up over a few years, it's over the past month, it's a good company because the stock price is up. That's not actually proper reasoning. You want to actually look at the business, because sometimes stocks fluctuate drastically, as in the case of Palantir, where we've had over $300 million of retail money flooding into the stock, creating a bubble in the stock, trading at over 100 times sales.
It's probably the best in the world at what it does. It has no competitors. It literally has an endless mode, a quasi-monopoly.
One of the important lies, it's a lie, that these YouTubers like Tom Nash say is Palantir has no competition. That's not true. Palantir has competition from Microsoft, Snowflake, and Databricks. I have an investment in e.l.f. Would I say that e.l.f. has no competition? Obviously not. Maybelline and others, there are other makeup brands that compete in the mass market for cosmetics. And most businesses have competition, and Palantir is not one of the companies that doesn't have competition.
So we have a system, right? You heard the system many times before. When the stock drops, we buy more. When the stock runs up, we slow down. So over the past 30 days, Palantir has done 54%. That is insane. Now we have a rule that if a stock does more than 20% in the past 30 days, we go to half speed. Dollar cost average buy at all times, yes, but half speed. If the stock is within the normal range, we buy normally. And if the stock drops 20% below the highest point it's been over the past year, in that scenario, we're going to double speed, right?
We're seeing one of the craziest investment advice I've ever seen that will bankrupt you. The idea that if you invest dollar cost average into Palantir at any price and you buy it, and regardless of the fundamentals, you buy more when it goes down, and you buy less when it goes up, but you always buy, is sort of absurd. What if the business isn't doing well? What if the stock is at 100 times sales? See, he says buy the dip, but the dip for Palantir went to 80 times sales, which is still 4 times the valuation of Snowflake. So it doesn't make any sense. He's a stock price pro, only looking at the stock price. You have to actually look at the business. Okay, so let's look at the business. Last video I looked at the valuation, but we can actually look at some of the business fundamentals, which actually aren't all that great. See, usually software as a service companies look at things other than sales and earnings to predict the future, but because Palantir is a meme stock with very little justification, they'll look at sales beats and earnings beats while missing some of the issues. So one of the key metrics for software as a service businesses is remaining performance obligation. As you can see from the chart, remaining performance obligation year-over-year sales growth has year-over-year growth has declined 20%, and on a 2-year stack basis, it's declined 5%. So that means you combine the growth of 2 years. It helps even out any noise. So both are declining. Billings is another key software as a service metric. Billings sequentially were down 5%. I made a nifty chart here which predicts sequential sales growth. I used a metric that Palantir actually has discussed in its slide deck. So they discuss billings and they discuss remaining performance obligation only when they look good. But you can get the numbers if you look at the deck. And I charted, so it's called a change in contract liabilities. And that's the difference between billings and sales. So when billings are higher than sales, there's a positive change in contract liabilities. And when billings are lower than sales, there's a negative change in contract liabilities. And I've seen that there's a correlation. When billings are higher than sales, it usually predicts higher sequential sales growth. And when billings are lower than sales, it usually predicts lower sequential sales growth. So I actually, so we see last quarter was actually really strong on sales, but billings were weak, remaining performance obligation was weak, and the change in contract liabilities were all weak, which implies that sales growth will slow. So remember, sequential sales growth in the last quarter was 14%, which was extremely high. But with the negative change in contract liabilities, I predict about 4% sequential sales growth. And that is a very big problem for Palantir because Palantir trades at a very high multiple of the 80 to 100 times sales variety, depending on where the stock is at in the past few days. So the valuation is so high that they have to beat estimates constantly, which creates a problem. It's like running on a treadmill and the treadmill keeps getting faster. Well, that's what happens when your valuation gets so high that the ability to beat is the bar is higher. It sets higher and higher and higher, which creates a problem. But this is a momentum-driven stock. Not that much fundamentals, mostly just piling higher and higher into momentum and more momentum. When the momentum breaks, as we've seen, the stock crashes very hard on basically very little news. We saw Alex Karp is selling. What's new? There's been tons of insider selling for Palantir, and there's some issues with the budget for defense contractors and stuff like Palantir, where there might be a cut, there might not be a cut. That uncertainty caused the stock to fall a lot, but really it was just a high valuation. The whole thing is a bubble, and Tom Nash is promoting this as this great stock where you could buy it at any price, when that's going to really hurt you as an individual investor because the valuation is so high. When it goes down to trading at 20 times sales and maybe even lower as sales growth slows, that'll cause an 80% decline from the top. And Tom Nash will have told you to buy it now, and as it goes lower, as you lose more and more money, he'll keep telling you to buy it. And that's a terrible way to invest because stock-based compensation is extremely high, diluting investors. Insiders are selling left and right because the business is not valued correctly. We have remaining performance obligation growth slowing. We have billings declining. We have the change in contract liabilities weakening. And all those things while Tom Nash tells you to buy the stock at any price for any reason because he just wants to promote the momentum, because it's part of his brand. If the stock goes up, he can sell more courses. But how is the business actually doing? He doesn't care. How the valuation is correct? He doesn't care. Valuation is the exact most important thing when investing because the valuation is like the spread when you're gambling. That is the rules of the game. Valuation are the rules. If you play where you're valuing a company really highly, the rules are very strict. You make a small miss, your stock crashes. However, if you buy a company that's cheap, then you have a better chance of making a profit. Of course, the market knows this, so usually the better companies are more expensive and the worst companies are cheaper. It has to do with growth and business strength. Well, that's why you have to find the diamond in the rough. You have to find companies that are really strong, that can grow really strong, and are valued cheaply. But that's actually hard to do, and unfortunately the YouTubers, the meme promoters, they don't actually look at their hundreds of companies to find one. They just find the most popular stock and tell you to buy it, and they don't really care if you make or lose money. You will lose money because Palantir is a bubble.